Okay, we start with some marketing. So I'm Lise Lindbäck. I work with Nordic. We are a public-private partnership, and Norfund is one of our founding fathers. So I'm delighted to welcome you to this last panel of the day, the only thing between you and the drinks that will be served out there. So, and I also learned today that the DFI community, they love SMEs. But at the same time, we know that some of these SMEs, they struggle with access to finance. And today, in this panel, we've been challenged to go beyond the tech hype and discuss whether tech is what can help fill the gap and provide the much-needed finance to SMEs. So I will be joined today by Carol from Ecobank. Ecobank is, as you may know, one of the largest Pan-African commercial banks, and Norfund, and the Dutch DFI, FMO, is one of their investors. And then we also have on this panel, I have to sort of my cards, Dino from AwanTunai, and Telef told us during his introduction that you use machine learning to provide loans to SMEs in Indonesia. And finally, we have Prasanna from Arya. And what he provides is a safe storage place for smallholder farmers, and then he allows those farmers to use their grains as collateral for a loan. So let's go over here. And I think you can sit next to me.
All right, yeah.
And you sit there, and you can sit there. Okay. So, we have been given 20 minutes or so to answer this question. And my ambition, and then let's see how it goes, is to touch upon the importance of tech, the challenges, the opportunities, and the way forward, and in particular the role the DFIs can play in that respect. And towards the end of the panel, we will also have an interactive session where you in the audience will be asked some questions, and then we'll have a discussion on whether your answers are surprising or not. So let's see how that goes. So there's a lot of hype about tech. And Dino, how important is it really for your business model?
Certainly AI helps, and I hate to use the word AI because it's now so cliche. Every single investment deck out there has AI. The reality is, for us, the real solution is never just one component. Yes, we use machine learning in a lot of algorithms that certainly helps with our risk management, but we also have a lot of human processes, field processes, and that hybrid model is what we've developed over 5 years of operation. So, sometimes my complaint of the VC investing is they see something new and shiny, they don't fully understand it, but the growth is a J-curve, so they invest $20, $30, $40 million into it. Yet, what I mentioned earlier is, I think you really need to understand, does the technology make sense? And that's sometimes not easy to detect.
But could you have started your business 10 years ago?
So my chief science officer actually told me, on a single, let's say, underwriting case, AI cannot beat a human being. Now, that's a profound statement, because I'm a non-technology person. I said, really, Ying? Like, AI can use 40,000 variables? And says, no. I'll take a very simple layman's example for this. One of our human manual processes is an underwriting call. One of my underwriters will call the borrower just to ask them 3 questions. Are you the borrower? Is this your emergency contact? And is this how much you've borrowed? In a model, those are 3 variables. But that conversation, that human conversation, is what they call an unstructured event. An experienced underwriter listening to that conversation, if the borrower is answering in a suspicious way, he will answer more. He will ask that +1 question. A machine can't do that. It needs to be taught by human beings. So that's the lamest example of the humans actually need to teach the AI, and why we work with a hybrid model. So when we first started, it was all humans, but the machine learning helped automate some of those processes.
Okay. And Prasanna, to your line of work, how has tech helped you reach the underbanked?
So I think, when I look at tech, I look at it as probably those chords in a guitar, and you have that pick which sort of makes sure that the voice and then the melody sort of comes out of it. When you're working in agriculture in India and similar geographies, you're solving for economic inequities, you're solving for gender, you're solving for climate, and you're solving for food loss in the context that we work in. And when you're working around that, we've seen technology play the role not only in terms of what digital tech does, because today when we talk of tech, the only thing that you think about is digital. There's also a lot of tech that is available which makes sure that that access to finance really happens when you work with farmers and their produce. For example, hermetic technology to store produce at the farm gate where no warehouses exist. Now, that and then technology, as Dino mentioned, embedded in the reality of your customer. I can't just bring technology that I feel will solve a problem, but we need to identify the problem first and then look for technologies that would solve it. So for us, we use hermetic storage technology to store the produce. We use AI-enabled cameras to provide surveillance of warehouses in really rural, deep markets. We use technology and machine learning to ensure that you're able to disburse a loan within 5 minutes of the farmer storing the produce. And that is what offers the farmer the choice to really decide when she wants to sell her produce and to whom she wants to sell it to.
Okay. So the way I read you is that it has been important. You couldn't have done what you're doing today had it not been for the technological development, but there's still room for humans. So I find some comfort in that. So, but there must be some challenges as well. And Carol, one of the things is that, of course, with new technologies, there's an option to collect a lot of customer data, and that comes with some ethical challenges. How do you deal with those?
All right, and thank you very much, Lise, for having me as part of this panel. I think that giving the opportunity to share some of the stories in Africa is great. But let me, by way of a background, Ecobank is currently the Pan-African bank with the largest footprint in Africa. We're about 33 markets. So in terms of being the exposures to things like ethical dilemmas across the continent, obviously we have a huge exposure when it comes to those sort of issues. Some of the ethical dilemmas that we typically deal with around customer data confidentiality. In Africa, there's inconsistency around privacy laws that revolve around such customer data confidentiality. The average individual there actually does not just understand the sort of rights that they have on granting access to various aspects of their data. So you see a lot of data that is readily available for use freely. So the ethical dilemma actually exists where you start asking questions around, is it right to use this sort of data where a client has not necessarily given you the permission to use, but the client themselves don't even know if they can give you such access to it because there are no regulations around that.
How do you deal with that?
The truth is, it's a constant educational process of getting them to understand that your data is absolutely important to, for use. Data today is commoditized, so you have to ensure that whatever information you're giving out there is what is relevant and what is useful for whatever initiative that is being put to use. Various regulators have various ways in which they're treating it. Some of the African markets are more advanced than the other African markets, but as we see now, I think it still boils down to those that are utilizing the data to be able to tell themselves that this is what should be used in terms of the data that has been made available.
Okay, so do you think regulations will be the solution?
To a large extent, it will be. Yep. So we have GDPR regulations in most of the West, but very few countries in Africa actually understand that is absolutely critical for you to put in place. Yeah. So definitely regulation would help to that extent manage how some of these data are actually utilized.
And then, what have been the main challenges you have been facing in terms of scaling up the use of technology?
I actually like to reiterate the regulatory part. Any business, especially a highly regulated like a business as lending, as it scales up, it will come under more and more regulations. And perhaps what we've seen in North America, North Asia, a lot of fintechs originally grew very fast due to a compliance advantage. Right? They simply had an easier license to deal with. But as the regulations converged and they became face-to-face with the banks, they couldn't compete anymore. And in some ways, this is why at AwanTunai, we've really obsessed about trying to build a true competitive advantage on risk management. Because if we make money, and this is the real way to scale impact, everyone copies what we do. Everyone follows, including the banks. And we actually want that. But for me, as I guess, running a business, I want to make sure that I can survive the competition. Should a big bank copy what we do? Can we survive that? And
are you making money?
Say again?
Are you making money?
We are EBITDA positive, and by year end, we will be cash flow positive. Yes.
That's good. That's good. So, in terms of challenges, Prasanna, what type of challenges have you been facing, in particular versus your clients? To what extent are they sufficiently educated when it comes to technologies and the use of technologies?
Yeah, so I think that's the greatest challenge, and that's also the opportunity. Because when we sort of today aggregate about 3% of India's total grains that are produced in the warehouses that we operate, and it's at one level it's a sizable number, but at the same time there's a long way to go again, and the digital adoption is the core kind of issue that we face. For example, simple aspects like the smartphone penetration in these markets, the availability of internet in these markets, when you operate and sort of link physical infrastructure like warehouses to do that, the availability of electricity is another challenge. So these are very basic yet significant challenges in terms of making sure that there is technology adoption that happens at that level.
And how do you deal with them?
So for us, it's a process. So the point is that the moment you make sure that the tech you use is embedded in the reality of your customer, you make it in a way that the customer understands is advantageous for her. For example, all the loans today that we give out need to be approved by the borrower just prior to the disbursement. So the borrower knows what is the interest rate. Since you're lending against commodities, the borrower should know what is the price at which you are lending, what is the loan to value, what is the bank account into which this money is going to be disbursed into. The moment you've made it relevant, now you see that each and every customer approves this, whether it is through a smartphone on a web application, whether it is on the Arya.ag app, or it is an SMS, or it is an assisted practice where one of our executives would show this and through an OTP make sure that the approval happens. So the whole idea is to make that technology relevant to the customer in his or her own context. And it's a journey. And we also, what we've done is to have leaders from within the communities be the channel for this communication.
Okay.
So that's the other thing.
Okay, I learned that time is running fast. We're approaching the interactive session, but let's go back to the question we started with. Is tech the enabler that will help us close the funding gap for SMEs? What do you think, Carol?
I think to a large extent. And I say to a large extent because tech itself actually simplifies some of the basic issues around, number one, disbursements, loan disbursements. And I'll give you an example. So in most of Africa, for instance, the basic, telephone, right, smartphones are typically utilized for a lot of things. It's driven things like not just access to financial services, access to credit. It's driven a lot around how information is shared. Now, the story always is that in Africa, for instance, smartphone penetration is not that high. But if you look at it in absolute terms on the population size in Africa, there are very many smartphones in Africa.
There are.
And there are a lot of things being done on the back of those smartphones. So smartphones in itself, number one, can help in driving financial inclusion, can help in driving access to credit, and all the concept around, mobile money agents, for instance. It's helping to create jobs massively across the continent. If you look at Nigeria, for instance, today there are about 17 million mobile money operators, agents. A decade ago, that didn't exist. So that gap in that gap in terms of access to finance, technology will play a large role in definitely ensuring that the gap is closed.
Okay. And in the audience here, we have a lot of DFIs. And Dino, what role can they play?
Sure, and I think it's really directing the investment dollars to real technology. And allow me to explain. We partner up with many banks, and one of the risk directors have told me, Dino, we get fintech presentations all the time. It's all about this magical black box AI that produces zero NPL, which is not true. And so if I can give a real concrete example of what technology is capable of. So our underwriting process is we take all the transaction data of a wholesaler selling to mom-and-pop grocery stores. That's hundreds of paper invoices and hundreds of purchase orders. Now, in our early days, 2019, my team were manually inputting all that information into the database to essentially validate what's the true sales data of that company so we can calculate the real working capital requirement. It took 3 people, 7 days to do that, going down, collecting all the paperwork. Now it can be done in minutes, right, where you simply photograph hundreds of invoices, or better yet, we have an ERP system deployed in the suppliers. So that's the true power of technology. We can do essentially forensic accounting, which is even deeper risk management than corporate banking type risk assessment at the SME level, which is unprecedented. And that's why we hope the DFIs supporting us can actually signal to the market that says that, hey, this is the real technology that works, and also the banking industry that's supporting us. This is what we're willing to back, and hopefully then success breeds emulation. People will simply copy, and you spread the impact.
Okay, so there's definitely a role for them.
Absolutely, leadership.
That's good. So I promised you an interactive session towards the end of this panel. So, and looking at my watch, I see the time has come to take your phones. Hope all of you have them. They should still be on silent. And then there should be a code. Yeah. If you scan that code and then answer the first question that pops up. Perhaps my assistant down here can tell me when it's done so I can continue. Is it working? Yeah. So, and while we wait for the result, so the first question is about the relationship between access to funding and companies' ability to create growth. So, Carol, what do you think the audience will respond?
Absolutely, I think that's very important. So, yes, when you create that access to funding.
Yeah, but on a scale from 1 to 6?
I will put it at 7.
Okay, do we have the results? The scale was from 1 to 5. So 57% says that there's definitely a link. And Prasanna, what does that tell us, that response?
That's quite obvious, right? In terms of saying that more businesses will be able to create more and better jobs if they are able to borrow money. It is certainly true, but at the same time, that is responsible lending, which makes sure that one of the things that we've seen, most businesses when they get access to money also tend to diversify and sort of divert funds, and which is where the whole purpose is lost, and which is where I think as lenders, as responsible lenders, we need to make sure that those guardrails exist, which makes sure that the money is used for the purpose that is borrowed.
Yeah, and that's a very valid point and very important thing. So we have more questions for you. Let's try one more. You may need to rescan the code. If the question doesn't appear, but the drill is the same.
Whilst people are scanning, if I can just add a real data point to that.
Yep.
So in our early days when we didn't use transaction data, our default rate was 5% a month. That's 60% per annum. That was irresponsible lending, right? Because we're formally excluding people from the credit markets because we have the credit records. Now we're performing at 0.2%, wow. And the year-on-year sales growth of our customers is roughly 30% each year. And I can guarantee you they're adding jobs.
That's very good. So this second question goes straight to the core of this panel. So does fintech have the potential to dramatically increase small and medium-sized companies access to finance. So Prasanna, this time to you. How do you think the audience will answer?
I think they would. There would be a resonating yes to this. And I mean, what fintechs have done, I think the role of fintechs, and especially in developing economies, has been not to, in a way, completely change things. They are quite efficient in their own ways. What technology and fintechs have been able to do is to make sure that the inefficiencies, some of the opacity that exists in transactions, those are addressed, and which is how you make sure that there's greater transparency and greater access to financial resources for businesses. And that is what, in a way, helps in achieving that objective.
Okay, so let's see what the audience says. Okay, I think we still a high score. I will say 64% of you believe that actually fintech have the potential to dramatically increase the access. So that's good for those of you operating a fintech. And Carol, what do you think about the results? Do you think fintechs will be that important?
I think so, because if you look at some of the challenges SME face today around access to finance, one is around collateral requirements and then cost. Now, for fintechs, if they are able to help through the new types of technologies, whether AI, robotics, and be able to create some background credit scoring methodology that is able to ensure that you don't demand that level of collateral from SMEs, that would definitely help. From a cost perspective also, why traditional banks will price for higher risk because they are not able to do a proper credit risk assessment of an SME compared to a corporate, a fintech, because of the credit scoring background, is already doing that, and so they don't have to price for risk when pricing for an SME. That is why the fintech would actually be able to provide such.
And that's exactly what you're doing, isn't it?
It is, but there's one missing piece here. To really, really scale, fintechs have to be able to collaborate with the banks.
Yeah.
Because that's where the lending capital is. And this issue of fintechs integrating into the banks, I honestly haven't seen it at scale yet.
Do you expect it will happen? Have you seen it?
Yes, I've seen that, and that's been probably one of the ingredients to our success. For example, when we disperse about, say, $1.5 billion worth of loans annually, only $200 million goes from our own books. The rest comes in from banks. One of the challenges that I've seen in banks coming in is that initial sort of a problem in their own minds to address the kind of customers that as organizations we address. For you, the smaller SMEs, and for us, probably the farmers and the farmer organizations. And banks really look for those vehicles that could take them there. In India, we also have a regulation which helps us in this because banks have to lend about 18% of their total credit book into priority sectors, which include farmers and farmer organizations. So I think it is exactly that collaboration which makes sure that this happens. And instead of fintechs really looking to compete with banks, it is actually the collaboration that really works.
And do you agree to that? You, the only bank on this panel. Carol.
I was actually turning elsewhere. I absolutely agree that there should be some level of collaboration with fintech. Some of the concerns around such collaborations, if I look at my experience from Africa, are the fact that fintechs are not as regulated as banks. They have some advantages that banks don't have. They are able to sometimes, or they do some things that are maybe unethical because they're not that safely guarded. But if you're looking at being able to scale, giving partnerships with fintech is definitely the way to go, because they don't have some of the overhangs that banks have in terms of the cost considerations, in terms of the regulatory overhangs. So definitely such collaborations through APIs and all that, like a sandbox framework, will definitely help.
And I think what you're saying there provides a good bridge to the last and final question, which is about regulation.
Yeah.
So you know the drill by now. And Dino, what do you think the audience will respond to this question about regulation?
Well, my hope is that DFIs can somehow help influence regulations to enable better collaboration between the fintechs and banks.
The banks?
Yeah.
Yep. Okay. Do we have an answer? Yeah, here it's more balanced. At least it's not the 3.9. A lack of appropriate regulation is a bigger problem than too much regulation. And I think that this is nuanced, I will say, feedback from the audience. So what does this tell us, Prasanna?
I think, like, for example, lack of regulation sometimes actually helps in terms of, trying out newer ideas. We've not had sandboxes in other countries, and in India still we lack, having those sandboxes. So that helps, but at the same time, an overall oversight around what's happening is extremely important. The ability for regulations to stay in touch with all the things that are happening is also extremely important. So there's space for people to try out, and also at the same time under the oversight. And then the regulations sort of come in formality, which then helps us scale from there.
Okay, I think we could have discussed these issues for a much longer period, but that was the last question, and that question concludes the panel for today. I will not take any more of your time. I'll just, before I leave you for the drinks, I would just like to say a big thank you to the three of you for contributing to this brief and quick conversation. It was interesting, and I suggest we give all the participants a big hand.
And the audience too.